Imagine you found a great deal on a piece of real estate. You don't want to own it yourself, but you know a lot of other investors who would love a property like this, so you agreed to buy it from the seller for $100,000. Meanwhile, you also know of another investor who is ready to buy it from you for $130,000 as is, and they can close immediately after you purchase it from the seller. The initial purchase and sale between the seller and you is the A to B transaction, and the purchase and sale between you and the end buyer is the B to C transaction. This is known as a double closing, when there are two separate transactions that occur on the same day, sometimes just minutes apart from each other. As you can imagine, if you can put two transactions together like this, you can potentially make a lot of money very quickly. However, since you literally have to buy the property outright, even if you'll only be the owner for a very short time, you're going to need a pile of cash in order to do this, because a conventional mortgage lender is not going to give you the money to do this kind of transaction. So what if you don't have the cash? What are you going to do? This is where transactional funding comes into play. Some people call it flash cash or same-day funds, but all those names are really just referring to the same thing. Transactional funding or flash cash is basically a short-term loan that is borrowed and paid back very quickly, usually within the same day, and it can provide the funds needed to make this first A to B transaction happen without using any of your own money. Now, obviously, if you have your own cash, you can use it, and that would make things very simple. But not every wholesaler has hundreds of thousands of dollars of cash just sitting around waiting to buy properties outright like this. And that's where transactional funding becomes very useful. Transactional funding or flash cash is typically provided by a hard money lender or a private money lender, and is only used when there is an established and well-documented end buyer in place. The end buyer should be ready to buy the subject property from the wholesaler immediately after the wholesaler purchases the property in the A to B transaction. And once the B to C transaction is complete, those funds are used to pay back the transactional funding loan immediately. Transactional funding can be used with any type of real estate as long as the closing agent is willing to facilitate both transactions and the lender can verify all the important details before they disperse the funds. Transactional funding provides a lot of advantages to an investor who is working as a wholesaler or the middleman in a double closing scenario. First of all, the wholesaler can keep a clear separation between the seller and the end buyer, which reduces the opportunity for both parties to cut the wholesaler out of the deal. Transactional funding is typically for 100% of the purchase price, so the wholesaler doesn't have to contribute any of their own money to complete the deal. It also puts the wholesaler on equal footing with other cash buyers, which gives them a competitive edge to close the sale. Transactional funding can be used for any type of property, whether it's vacant land, single or multifamily homes, condos, REOs, and all types of commercial property. And funding a transactional loan takes place in a matter of days, which makes it pretty ideal for a quick closing. Transactional funding is typically less expensive than hard money loans, and the fees are paid at closing. And although the advantages tend to outweigh the disadvantages, it pays to know the potential pitfalls of using transactional funding as well. For example, transactional funding is very short term, with most lenders requiring full repayment within 1 to 3 days, and some transactional lenders will offer extended terms at a higher rate. And if for some reason the deal doesn't close in the agreed upon time frame, additional fees and interest can get pretty expensive. And how much does transactional funding typically cost? Well, given that you're only using the money for like a few hours or even a few days, it's not cheap. The fees associated with transactional funding can vary based on the loan amount, the length of the term, and how risky the lender perceives the deal to be. A common fee structure for a lot of flash cash loans can be anywhere from 1 to 2.5% of the loan amount, but it can cost more if the term extends longer or other risks come into the picture. It ultimately depends on what the lender and borrower negotiate. So what if you can't or just aren't willing to deal with a transactional lender? Well, some other funding sources you might consider would be asset-based hard money loans, private money lenders, joint venture capital, home equity lines of credit, or business lines of credit. If you want to learn more about how transactional funding works, be sure to check out the full article over at retipster.com, which you can find linked beneath this video. And if you want to expand your real estate knowledge, be sure to check out this next video, and we'll see you there.